In terms of silver, the closing above 32.50 is incredibly bullish because that was one of the resistance levels. There might be one more at about 35. After that, there's nothing between it and 50. So it's been trying and banging its head against that level and now has closed through it. Where it goes from here, I don't know. Russia openly saying they're going to add to it as part of their state stockpile. Now, no countries have said that ever, really, to my knowledge, and now Russia is. So you have countries realizing the weakness to the system, or the way to beat the West is not through military engagement, but it's to stand for delivery, which is kind of the back door that no one ever utilized on COMEX and the LBMA. And you have 8 commercial banks on COMEX, Western banks, that hold the largest concentrated short position in any commodity ever traded on COMEX. And you have between 4 and 6 billion ounces short in silver by pretty much the same group on the LBMA. So if silver went up by $2 on Friday, that's between what, $8 and $12 billion loss to these banks. Now, I can't give you a definitive number how many ounces because it's an over-the-counter market in London. It's not an exchange where there is a central exchange authority that monitors everything. This is a over-the-counter handshake type of deal. It's more opaque. It's not as transparent, but we do know that roughly between 4 and 6 billion ounces short on London by these banks, and they're hemorrhaging. And how much longer can they take this acting in concert together in a collusive manner before they say, every man for himself, I'm out, bye, you deal with this, and they start to cover. And as covering happens, which is hard enough in and of itself because these contracts are 90% paper, what happens to the price? I mean, it just goes up, which then snowballs the short covering price going much, much, much higher. And again, this is all because of creating this illusion that, holding the price of gold and silver down. And you can say it's because of the military industrial complex's need for silver. You can say they hold gold down to make the bond market and the Western system seem stronger than it is. Whatever the reason is, it is been discovered by China, Russia, India, Saudi Arabia. They're all exploiting the delivery feature option that no one ever did before, standing for delivery. And these entities, well, they got enough money to challenge the commercial banks and wherewithal to stand for delivery. They don't get scared by a margin call. If the price starts to fall, that's okay. Here's a little more margin. We're still standing for delivery. Thank you very much. And that's what is creating an existential threat for some of these banks. And all it takes is one to go down when the daisy chain starts to really get crazy, not just in precious metals. You're talking the biggest commercial banks in the world, Citi, JP, Goldman, UBS, Deutsche Bank, Standard Chartered. These are banks that if they make a default in one area, what does it do to the rest of their book on all of the other types of assets that they trade in? So yeah, I think we're right there at that Rubicon. And in terms of silver, the closing above 32.50 is incredibly bullish because that was one of the resistance levels. There might be one more at about 35. After that, there's nothing between it and 50. So it's been trying and banging its head against that level and now has closed through it. Where it goes from here, I don't know. Let's look and see, what is it doing here today? What do we got silver at?
33.88 right now.
Yeah, so I mean, and they're hitting it today. It was way up. It's coming down a bit right now. And it's interesting, when you look at it, it comes down right at the same time every single day. When they hit it, it's right about 10 a.m. in New York, Eastern. This is the algorithms trying their best. Now you watch, my guess is it will pop back up, but it's shown amazing strength and resiliency lately. And every time that the West is foolish enough to add shorts to knock it down, there are people saying, thank you, that's a subsidy, we'll buy more and we'll stand for delivery. I'm not even talking the retail here. I'm just simply talking the most influential and well-funded and well-informed traders in the world, largely the commercial banks and the central banks of the globe, realizing that this is where we're heading. We're heading away from debt instruments and promises into tangibles in my own possession.
In recent developments, Andy Schectman has been vocal about the growing trend among nations to accumulate physical gold and silver, viewing it as a strategic hedge against potential economic fallout and an opportunity to challenge the financial stronghold of the West. Countries like Russia, China, and India, recognizing the vulnerabilities within the current monetary system, have doubled down on their purchases of precious metals, seeing this as a chance to weaken Western economic influence without engaging in direct military conflict. Schectman emphasizes that Russia, in a unique move, has openly declared its intention to add silver to its state stockpile. This bold declaration signals a shift in strategy. Rather than accumulating fiat currencies, nations are placing their bets on physical assets like silver, which have historically held intrinsic value. Russia's commitment to silver as part of its national reserves is significant because it represents an evolving understanding among global powers that silver, much like gold, can offer a solid hedge against the instability of fiat currency. At the heart of this strategic shift lies the complex dynamics of the COMEX and LBMA, London Bullion Market Association, markets, which serve as central hubs for precious metals trading. Schectman points out a striking imbalance in these markets, where Western banks, particularly on COMEX, hold some of the most concentrated short positions in commodities history. These positions amount to billions of ounces of silver, a large percentage of which are paper-based contracts rather than physical holdings. These paper contracts, primarily short positions, allow banks to speculate and keep silver prices artificially low. Yet if silver prices rise even by a small margin, these banks could suffer massive losses due to the sheer scale of their positions. Schectman emphasizes that when silver recently rose by $2, this seemingly modest increase translated into a significant loss for these banks, an estimated $8 to $12 billion. Unlike previous years, countries like China and Russia are no longer content to accept the paper facade of precious metals trading. They're instead demanding physical delivery, a move that Schectman describes as standing for delivery, a practice where the buyer requests physical possession of the commodity rather than merely a paper-based promise. This shift towards physical delivery is monumental because it challenges the very foundation of the paper-dominated precious metals market. By opting to stand for delivery, these nations expose the weaknesses of an opaque system that has long relied on an overwhelming amount of paper contracts with limited physical assets to back them up. So why are these nations so keen on securing physical silver and gold? The answer, according to Schectman, lies in their understanding of how these assets can stabilize a nation's economy in times of global uncertainty. Holding vast quantities of U.S. treasuries, as many countries have done, now presents a growing risk due to geopolitical tensions, sanctions, and the Fed's ever-changing monetary policies. Central banks, particularly those in emerging markets, have recognized the need to minimize their exposure to U.S. debt instruments and instead stockpile physical gold and silver, which hold their value independently of political pressures. In Schectman's view, we are on the brink of what he calls a Rubicon moment in the silver market. Silver has recently broken through the critical resistance level of $32.50, a threshold that traders have watched closely. With the next resistance point at $35, if silver crosses this level, Schectman predicts little to no resistance left between it and $50, a price that silver hasn't touched since 2011. He argues that this trend of rising prices is only the beginning, as central banks and sovereign wealth funds continue to buy more and more physical silver. Beyond mere price fluctuations, Schectman highlights a more troubling issue for Western banks. If one of the big banks fails to cover its short position, it could trigger a domino effect that ripples across the entire financial sector. If a single major bank is forced to default on its silver obligations, it may struggle to meet other commitments across its portfolio, leading to potential systemic risks within the global financial system. For Schectman, this scenario underscores the existential threat these banks face as silver prices continue to rise and as countries increasingly stand for delivery.
Gold making all-time highs. It's the 34th of the year, all-time highs. You got all the BRICS nations buying up gold, and that demand, it's not stopping. It's not going anywhere. They're buying it at a record pace, and I think that this is just beginning. It's broken through resistance levels, of course. We're at all-time highs. It continues to march higher and higher and higher, and how high it goes, I don't know. I think bull markets go higher than anyone thinks possible. I think that it will be tied to a new system, but in reality, what I think it is more than anything is a realization that central banks around the world do not have the appetite for our treasuries any longer that they once did. Not only are we proving to choose inflation instead of letting the underbrush burn, letting Mother Nature clear everything. We're meddling again and lowering rates and reigniting inflation. That's why the bond market sold off and rates on the 10-year have been going higher, because they understand this. But of course, as we've talked about incessantly and ad nauseum, it's the weaponization as well, where we are, taking $5 billion in assets from Russia and buying weapons to give to the Ukraine. Our policies are making countries around the world want to own things like gold instead of owning our treasuries. Not only has it doubled the performance of the 10-year, has no counterparty risk. And by the way, on COMEX, on the LBMA, London Bullion Metals Association, you're seeing roughly two times global market production traded every day in London. They have way less metal behind these trades. About 90% of these trades are paper trades. And if called on the carpet, it creates a very big problem. There's not even enough gold in the exchanges to come up with, to deliver if need be, but more so in silver. Let me look at the numbers here. You mentioned that silver made a 12-year high. It's true, closed up 6.5% on Friday. What's going on with silver is ridiculous. You have 3.5 times global mine supply annually traded every day in London. There's 800 million ounces in the entire LBMA vaulting system, of which 500 million belong to the ETFs. That leaves 300 million ounces there that could be delivered. Well, they're trading 2.9 billion ounces a day, which is 3.5 times annual mine supply, 10 times what is available, 90% of which is paper. 8.1% of all of that silver was delivered in the month of August, as these countries are standing for delivery. And you got analysts like Bank of America saying that gold will be 3,000 by next year. You have 3,100 by Goldman Sachs. You got Michael Hartnett from Bank of America saying that gold bull driven by policy and inflation. Investors simply need to hedge inflation and threat of US dollar debasement. Gold heading well above 3,000. Yeah, I don't think we've even begun to see where this ultimately goes, but silver is the value of a generation. And I think the entities around the world understand this. You have China, as I mentioned on your show before, going around the world buying concentrate and doré bars directly from the Latin American refiners. They are paying way more than the West will pay for it. They bring it home and refine it themselves. It's not purchased off of an exchange, which has a material effect on the price they're paying and on how much they're really accumulating. They already are the second largest producer of silver in the world. They have become a net importer this year instead of net exporter. India, of course, bought between 800 and 900 million ounces over the last 3 years. That's more than is on the LBMA.
One cannot ignore the ongoing geopolitical implications of this movement. Nations previously aligned under the Western monetary system, including BRICS countries, are openly questioning the efficacy of a US-centric financial framework. As they purchase gold and silver, these nations are, in effect, betting on a future where the dollar is no longer the primary reserve currency. This shift is accelerated by US foreign policies, particularly sanctions against countries like Russia. These sanctions, initially intended to punish and isolate, have inadvertently pushed nations toward alternative financial structures that rely less on US treasuries and more on tangible assets like gold and silver. Schectman frequently points out that a growing number of nations are now actively engaged in this alternative economic path. The BRICS countries in particular have become major players in the precious metals market, buying gold at record levels and diversifying their reserves away from dollar-based assets. This collective movement, Schectman argues, is a significant shift in the global financial landscape, one that could reshape the balance of power in international finance. By accumulating gold and silver, these nations are building a safety net that allows them to distance themselves from the Western financial system, fortifying their economies against potential currency crises. Schectman further observes that every time Western banks add more short positions to suppress silver prices, central banks and institutional investors view it as an opportunity to accumulate. This repetitive cycle is unsustainable in the long run and is likely to lead to an inevitable reckoning within the silver market. As these influential players continue to buy and stand for delivery, the available supply of physical silver decreases, driving prices higher and potentially setting off a short squeeze that would further elevate prices. The dynamics that Andy Schectman describes reflect an impending crisis that is multifaceted. Not only are we witnessing a fundamental shift in how countries manage their reserves, but we are also observing a dramatic showdown between Western financial institutions and emerging economies. In the grand chess game of global finance, countries like China and Russia are moving their pieces strategically, challenging the dominance of the US dollar not through military means, but through economic resilience and diversification. For Schectman, the actions of these nations signal a growing understanding of the flaws in the Western financial framework. Central banks have recognized that by demanding physical delivery of silver, they expose the vulnerabilities of the COMEX and LBMA systems. Schectman compares this realization to a backdoor exit, an option that has always existed but has rarely been exercised. By opting for physical delivery rather than paper contracts, these nations are not only accumulating valuable assets, but also putting pressure on the banks that have relied on leveraged paper contracts to manipulate prices. The implications of this strategy are far-reaching. If more countries continue to stand for delivery, the banks holding these massive short positions will be forced to cover their contracts, driving up prices and potentially causing billions of dollars in losses. This every man for himself scenario, as Schectman puts it, could lead to the unraveling of these institutions, particularly if one bank defaults and sets off a chain reaction. The fragility of the financial system is such that one collapse could spread across sectors, affecting other asset classes and plunging the global economy into turmoil. As we look toward the future, Schectman argues that silver's recent performance only reinforces his bullish outlook. Closing above the $32.50 resistance level was a crucial moment, and with limited resistance left, Schectman believes silver could rapidly accelerate to $50 and beyond. This possibility is not mere speculation, but is rooted in a growing trend of physical demand combined with the weakening of paper-based trading systems. Each time the price of silver is pushed down artificially, central banks and other powerful players seize the opportunity to buy at a discount, effectively subsidizing their holdings and draining the market of available physical silver. The rise of BRICS nations and their commitment to accumulating gold and silver represents a broader movement away from fiat currency and debt-based instruments. Countries like China, Russia, and India are not only purchasing precious metals at record levels, but are also actively discouraging their reliance on US treasuries. Schectman explains that these countries are choosing inflation-resistant assets over bonds that are increasingly viewed as liabilities. In a global environment where inflationary pressures are rising and trust in fiat currencies is waning, the preference for gold and silver is a logical choice. In recent years, the weaponization of US financial assets, particularly through sanctions, has fueled the demand for alternatives. The confiscation of Russian assets, which were then repurposed for other political aims, sent a clear message to other countries. Your assets are only safe as long as they align with US interests. This action has backfired, leading to a surge in gold and silver purchases as countries aim to safeguard their reserves from potential confiscation. Precious metals, unlike treasuries, carry no counterparty risk, making them an attractive option in an era of financial warfare. Schectman is convinced that we are witnessing the beginning of a monumental shift. Gold and silver, having already reached historical highs, are poised to continue their upward trajectory. The central banks driving this bull market have no intention of slowing down, and as retail investors eventually join the fray, prices could soar even further. Bull markets, Schectman reminds us, often exceed expectations. With each passing day, the case for precious metals strengthens as the structural weaknesses of fiat currencies become more apparent. One of Schectman's most compelling arguments centers on the long-term sustainability of the current financial system. He notes that in London's LBMA, 2.5 times the world's annual silver mine production is traded daily, most of which is in the form of paper contracts. If even a fraction of these contracts were called for physical delivery, the system would face a liquidity crisis. This volume of trading, unsupported by actual physical silver, exposes a dangerous disconnect between paper and physical markets. For Schectman, this over-leveraging of paper contracts is a ticking time bomb, one that could explode if enough nations demand delivery. In closing, Schectman offers a stark warning. The world is moving towards a tangible asset-backed economy, and those who cling to paper assets will be left behind. He sees gold and silver as more than just commodities. They are the financial lifeboats for nations that wish to remain economically sovereign. As these countries increase their reserves, the limited supply of physical silver and gold will only drive prices higher, setting the stage for a new financial paradigm. Schectman's insights offer a roadmap for understanding the complex interplay between geopolitics and finance. His advice to investors is clear: don't be fooled by temporary price dips. They are opportunities in disguise. As more nations reject debt instruments and move towards physical assets, the demand for gold and silver will continue to surge. For investors looking to safeguard their wealth, Schectman argues that the time to act is now, before the price of entry becomes prohibitively high. In sum, the shift toward physical assets represents a broader rejection of the debt-laden financial model that has dominated global markets for decades. By accumulating gold and silver, countries like Russia, China, and India are taking concrete steps to secure their economic futures, free from the constraints of Western monetary policies. The implications for the global financial system are profound, and as Schectman points out, the impact of these changes will only become more apparent as the precious metals bull market gains momentum.